All right. Well, everyone, thanks for joining us for this month's market update webinar, June 2023. Let's start with some disclosures. Silverstone Financial LLC is a registered investment advisor. Information presented is for educational purposes only. It does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Please be sure to consult with a qualified financial advisor and/or tax professional before implementing any strategy discussed within the presentation. And of course, past performance is not a guarantee of future results. Please check out our website for additional disclosures. And throughout the webinar, please submit any questions you have by using the Q&A button at the bottom. All right, quick bio about myself. My name is Jeremy Eppley. I'm an accredited investment fiduciary, accredited portfolio management advisor, and chartered retirement planning counselor. You can learn more about me on my LinkedIn page. And Silverstone Financial is a fee-only fiduciary registered investment advisor, which means we don't sell insurance or annuities. We have to act in the best interest of our clients. We provide comprehensive wealth management services, which includes financial planning, investment management, tax return filing, and even some estate services. You can learn more about our firm on our website. So this past month was interesting. No absolutely huge headlines, but a lot of small, important headlines. The biggest of which would definitely be the debt ceiling. There was, of course, the potential US default, lots of talking about that, a lot of worrying. I definitely had a few conversations with clients about discussing what has happened in the past. And usually it's always, bring it up to the very end of the line because they want to get as many concessions out of the other side because it's a partisan issue usually. But neither side wants the US to default because that would crash essentially the world economy. So luckily enough, the Republicans and Democrats came to an agreement. President Biden signed a bipartisan bill, ended the debt ceiling, and so far we should be good for, I think, another until after the next election at least, kicking the can down the road. But for now, we're good, which is always good to hear. The big news on at least the finance side that really moved the markets was the surprise job report. It outperformed significantly. We expected 195,000 new non-farm payroll jobs to be added, but instead the U.S. economy added 339,000. So quite a big upset in a good way. And that definitely helped push the market higher, and it's reducing the chances, or at least the outlook, of a lot of analysts seeing a potential hard landing with all the different rate hikes that the Federal Reserve has been doing. There's been a lot of worries, recession and other kind of significant crashes or problems in the economy or the financial system. But thankfully, so far, we're doing all right, and inflation has been coming down. Of those problematic occurrences that happen after rate hikes, push the financial system to the brink, we haven't seen any new bank failures in May. The last one was on May 1st when JP Morgan, acquired First Republic Bank. They closed that deal on the 1st. And so far, no future bank failures. I ended the last webinar talking about we're looking slightly better now that JPM prevented quite a large potential failure with First Republic. But we weren't out of the woods, and I'll still say we're not out of the woods. But it definitely feels good to see that there weren't a cascading effect where bank after bank after bank failed. But it might just be a pause, and we'll see more in the future. Hopefully not too much. Another big news that was happening at the very end of May into the beginning of June was OPEC Plus meeting. Saudi Arabia was basically runs OPEC Plus, and they announced that they're going to be voluntarily cutting about 10% of their oil production, which is about 1 million barrels per day, approximately. And they're essentially trying to bring oil prices up back above 80 is their sweet spot. So don't be surprised if this summer we see oil, or at least gas prices, slightly higher. But there's been, I was listening to quite a few market analysts on the oil side, and from the consensus that I've been hearing, even with these oil cuts, there are some macro factors that are pushing down oil prices. So we might end up seeing stability throughout the summer season, especially with if you guys are doing road trips or any other kind of high oil consumption activities. Hopefully it won't hurt the wallet too much, but we shall see. We shall see. Another big event that was happening, at least on our finance end, was the SEC, and this is more so beginning of June here, but they have ramped up their fight against crypto. Some people at least are seeing, Gary Genslinger, who's the head of the SEC, is not too appreciative or supportive, at least, of crypto in general, and has brought lawsuits. Of course, they can't bring criminal charges, but they can bring civil lawsuits and other kind of enforcement on that end against Binance and Coinbase, being two of the largest crypto exchanges, Binance being the largest, essentially over them potentially, maybe not, maybe so, having unregistered securities being exchanged on their platform. And that kind of falls back to the overarching dispute between the SEC, the Securities and Exchange Commission, and the CFTC, the Commodities Future Trading Commission. And one, of course, regulates commodities, and the other one regulates exchange or securities. And the problem is Congress has refused or has not been able to pass laws that clarify if cryptocurrencies are all securities or all commodities, or some of them are one and some of them the other, or they're both. We don't know. So essentially, a lot of these other crypto companies, crypto exchanges have been operating in a gray area, which doesn't help them and usually doesn't help consumers, and has ultimately ended up with this strange turf war of who has the regulatory authority to push against these exchanges and these companies trying to do sometimes some nebulous and nefarious activities. We'll see how it all goes. It hurt the cryptocurrency market slightly, but ultimately it's just a continuation of what has been happening. And if we hear more big headlines, I'll include it in future month's webinars. And the last big notable event, quite a lot to say about it, is inflation. It's finally coming down. We've been seeing, I've been having this month over month chart, which I like to show people because you can see the more jaggedness of how inflation is calculated each month, rather than when you hear when it was peaking at 9.1, the inflation rate, June 2022. What does that mean? Versus like now you're at 4.9, but you were feeling a lot more inflation, like quick increases in price at the grocery store back in 2022, but a lot of people aren't seeing or feeling as much inflation nowadays. And essentially what's happening is each month, these high numbers, which were pulling the June, May, July numbers high in 2022, they drop off and are being replaced by what has been a current interest rate environment of a range of low, 0, so basically no change in the inflation rate, to a high 0.5% change in a month. So what all this is to say is, in July and August, we're going to see these last two big candles drop off. This in May of 2022 was 0.9, and in June was 1.2. When those drop off, and it's expected that we'll have 0.3, 0.4, 0.5% inflation in the coming months, we're going to naturally, just by how it leaves the 12-month look-back period of the inflation rate month or trailing 12 months calculation, we're going to have an expected about 3.5% inflation rate, which will be the headline rate. It could be as low as 2.8, as high as 3.8, as long as we're somewhere within reasonable expectations, as long as there's no major spikes, no nukes go flying in between Russia or anything like that. But with that being said, when we get those headline numbers, which of course isn't 2% where the overarching Federal Reserve target is, but 3.5% is very different, especially in the minds of average everyday American. Then like 9.1% inflation is very scary. So I wouldn't be surprised when we start hitting these numbers that a lot of the news media headlines are going to be slightly different. It's going to be like, we beat inflation, and also the Federal Reserve will have at least less, not necessarily ammunition, but less rationale to be able to crush inflation and crush the economy. We'll see. I know they've repeatedly said they want to get it back down to 2% inflation, which will be hard because they have to keep pushing. But what I found interesting is a lot of commentators, and I agree with, is those last 1.5% is going to be the hardest to beat. And there's some argument to be made that it's okay to have slightly higher inflation for a long period of time, say for the next 10 years, of 3.5% inflation instead of 2%, because for the past 10 years, we've actually been under our target. So it's just reverting to the mean. And by having slightly higher inflation, we would be able to continue the higher growth rate. And as I had mentioned before, the strong economy, strong jobs report. So we'll see what the Federal Reserve will do, if they'll keep raising rates. Historically, the Federal Reserve always over tightens and then over loosens. They don't seem to learn from the mistakes. So the expectation is they'll probably over tighten and something will break, and then they'll reverse course. But hopefully everything will be all right. And especially on the investment side, the market always seems to recover, especially when these changes are temporary rather than permanent. The fear would be entrenched inflation long term. That, of course, would be the worst case scenario. Hopefully, coming months, we'll see some good inflation rate data that I'll be able to show you. But continuing on, Federal Reserve expectations, nothing really has changed. We had a 25 basis point hike in May. And next week, next Wednesday, we'll have the June meeting announcement. And consensus is 50-50. They're not going to do anything, or they're going to just do another 25 basis point hike. I am in the camp that I would prefer them just to pause for a while, but a 25 basis point hike, especially in comparison to what they did previously, is pretty minor. So either way, I don't think there's a right or wrong answer. I think it's impossible to know, but I will definitely let you know what they end up deciding next month. And I hope that, I of course could be wrong, but I hope that the Federal Reserve, whatever their action is, will lead to the best outcome for the markets, but more importantly for the economy. The economy impacts more people than the markets. So quick recap of this past month. This month was really interesting, especially when trying to communicate it with clients, because the mega caps were kind of the only part of the market that was performing quite well. NVIDIA was the leader. They shot up 30% in the month after a great quarter. What I found interesting, though, was they were up over about 200 billion in market cap, which is the worth of the company, in a month. And usually, in the opposite way, Facebook's the only company I can think of that has lost those kinds of numbers, where it's triple digit in the billions market loss after a bad quarter. And every time that those large moves have happened, it's been unsustainable. And usually, I've advised clients to buy the dip in those cases because the fundamental underlying company hasn't changed that much. And all those times it's recovered well, and it reverted to the mean, and it continued on, and that blip was not something that was indicating a future permanent price target, essentially. And NVIDIA was really interesting because they spiked it might be the largest spike in history, somewhere around 200 billion in a day or two. I personally don't see it as that sustainable, especially if we go into like analytics, which is a little bit outside the scope of this webinar, is getting a lot of these mega caps, which people return to year to date when after they had fled from all those tech names in 2022, are getting to the point where they're as highly priced as they were at the peak of 2021 when there was a lot of stimulus and such. So I'll definitely get into some expectations in the future slides, but we're probably getting to the peak in some of these mega cap names. A lot of fear and flight from the small caps going into the mega caps, but now it might be getting overextended. And NVIDIA was really the one that made me think this. It's such a large jump that it might be indicative of the overarching market. Beyond that, quick recap of all the different indices. Dow underperformed mostly because of energy stocks. The S&P 500 was practically flat. The only reason that it was in the positive territory were because of the 6 mega caps of Microsoft, Google, Meta, Amazon, Tesla, Apple, NVIDIA, and such. They were basically the only ones that were so positive that they held up the rest of the S&P, like Exxon, Mobil, and Chevron, which were part of the oils, were down significantly. So it was interesting to see. Ex-US, so the global economy, global stock market at least, down 3.7, 3.8%. Bonds having a slightly down 1%. Bonds usually don't move too much, but a 1% move is somewhat significant. Having more people move out of bonds and going into what's called a risk-on trade. So going from a relative less risky risk-off trade of holding bonds that we expect will return to a potentially risky, potentially loss of investing in equities. So an interesting shift, which we'll see if that will reverse in the coming months, which I'll talk a little bit more about in the coming slides. Gold still flat, crude oil dipping almost 11%. That's reversed slightly since the OPEC meeting at the end of the month, but still a significant drop in oil prices. And Bitcoin, the 8%, mostly attributed to the SEC fight and further regulations. And not even so, like a lot of times when we talk about crypto regulation, it's seen as a bull indicator, so a potentially good thing because it gives structure. But here, how the lawsuits were structured, a lot of people saw it as enforcement through regulation through enforcement rather than regulation that's built up and then compliance to the regulation. So it was seen as more combative and hurt those markets. Year to date, markets looking still a little bit better, mostly carried by those mega caps, up 20% year to date, which is really massive when you think about how much money is controlled by those mega caps. Is trillions and trillions of dollars. Up 20% is really significant. You see NVIDIA up 160% year to date. That's kind of what I've been saying is it's unsustainable. I won't get too much into geopolitics, but I've said previously that NVIDIA should either trade at a discount or barely at a premium to the market simply because of the worries with TSM, which is Taiwan semiconductor manufacturer, and of course, all the potential geopolitical problems that Taiwan, China, potential wars that could come out in the future years. So it was interesting to see so much money flow to these mega cap names that are heavily dependent on no war in between China and Taiwan, which would be interesting to see. Of the other indices that I would want to point out, Bitcoin's the other big one. Even though it was down 7-8% this month, it's still up 63% year to date. So it really got crushed 2022, still seeing that recovery. So the risk on trade, which I had mentioned before, going back from the flight to cash, flight to bonds, flight to mega caps and such, back onto the more risky or speculative side of investing, which might not continue. So I always like to bring up the seasonal fluctuations in the market, and this chart always is a good way to explain it. We just completed the best 6 months between November and April. Those are historically the best months in the market where most of the gains are booked. And June, August, September historically are losses on average. Of course, there are definitely outliers. But going into June, on average, we have trading flat to potentially a slight loss. It's, again, not in past performance, not indicative of future results. But I always like to bring this up to temper expectations, to explain that usually there's that recovery, and simply because there's that recovery or run up in this half of the year, that sometimes it's overdone. And the earnings, which come out in July and August, sometimes justify that run up, but other times it doesn't, and there's that sell off. So we shall see. So the last chart, the last slide for tonight, is usually the S&P 500 chart. And this month I want to do something slightly different in how I framed it. So I think I had mentioned last month where I was talking about the S&P 500 trading in a band, in a range is what it's called for finance, where it was trading in between 3,800 and 4,200. And of course, it broke out a little bit, it broke down every so often. But in general, this range is a pretty strong range. We have many bottoms, many even tops to it. And it feels like it is an appropriate price for where the S&P 500 should be. Remember, we peaked in 2021, and that was when there was a lot of stimulus going on, and everything had been repriced with Federal Reserve having reduced the rates down to basically zero. And when bonds and cash are returning zero, you have, and I had mentioned this before, TINA, which is there is no alternative. The only option is to invest in equities, to invest in the stock market. And that's what happened. And valuations, it's called the earnings multiple, got expanded. And essentially it was market inflation, where people were paying more for the same level of earnings. Now, when inflation started catching up, I had warned clients that because the multiple had expanded and because they're going to raise rates, when rates are risen, bond prices and things that have what's called finance duration, those prices fall. Stocks have a type of duration. Bonds have duration. So when the rates rose, markets inherently would fall. And of course, we had the Russian invasion that was a catalyst and kickstarted that process. But inherently, it was the increase in rates that revalued the market lower, where we shouldn't expect the stock market to return to the highs until either earnings go up, which earnings take a while to go up, or the interest rates fall. And right now, or if you remember the Federal Reserve slide, we were at either they're going to do nothing or they might raise it ever so slightly. So we're not seeing rates falling anytime soon. So I definitely am in the camp that this range of 3,800 to 4,200 is probably where it should be. And just in the beginning of June, we saw it break out of this range, and we're now near 4,300. I expect, now I hope I'm wrong, because of course I have clients that are invested and I want everyone to make money. But I would not be surprised if in the coming months we return back down to the 3,900 level and we continue trading within this range. It seems overbought, especially with NVIDIA being at a 200 PE multiple. Amazon was like at 140 or something like that. Like, these price to earnings multiples are super high. If we look at their forward PEs, which essentially means we look at their future earnings rather than the current earnings, they're still at 40, which is double what historical markets should be at. So I'm in the camp. I think we're overbought slightly, but this isn't something where I'm saying go sell all your assets or anything like that. It's mostly just understand that we've had these past 2 months, April through June, was remarkably flat, even though it might not have felt that, especially when we're dealing with the bank failures right here. I'm sure that felt very scary. But if you look at how much the markets moved previously, these big V patterns or W's or M's or however you want to look at it, this has been remarkably flat. And just recently we broke out with this kind of frenzy into these mega cap names. So I hope, when we're doing our July monthly market update webinar, that I say, yeah, we're at 4,400, everything's going great. But more likely than not, I would be guessing that we came down slightly and we're still trading somewhat flat. But ultimately, we shall see. All right, so we're on to Q&A. That was the end of the presentation. The only one that I had seen come in, and I'll wait for a second more, but had to do with this chart essentially. And it was talking about what some of the lines meant. And for those that aren't used to looking at different stock market graphs, this is called a candle chart. So the green lines are when the market goes up, the red lines are when it goes down, and the black lines that go up and down is essentially the range for that day. So sometimes you see a big spike like this day where there was a lot of volatility, but ultimately the close and the open didn't change very much. These ranges that I put on were just drawings from my end, so it's not how the chart normally looks, but it's just a range showing this dotted line 4,200 level and the 3,800 level, and this yellow part is where I would see the market being fairly valued. This box is just showing the month of May, so you can more easily visualize it. This was the beginning of 2023. And these lines, I think is probably what the question was referring to, is just showing the months range, the month band. And usually if you see something like this, and this isn't that dramatic, but it goes from slightly wider to slightly thinner. So it's a funnel. And that's usually considered consolidation. So the range is getting tighter, and usually it will break out either up or down when it ends that range. What we saw here, and this is pretty slight, this is really basic charting, but we broke out higher. And the question is that a new paradigm or is that unsustainable? And more so in the camp that it's unsustainable and we might sell back off. So that's kind of what the lines mean. Hopefully it's not too confusing. I try to keep the webinar understandable for most people. But that was a great question. If you want to talk more about it, I'd be happy to. All right, I don't see any other questions for tonight. Nice 30-minute webinar, not too long. It was great seeing everyone. I saw some familiar faces, and I hope to see you next month, hopefully with good news. Yeah, doors always open. Please email me if you have any questions. Have a nice night, everyone.